Hey guys, welcome to today's session. I'm going to give everybody a moment to join and make sure I've sent the link into the Darwinex Zero Discord. I'm feeling unprepared today, and I don't know why. Maybe it's just being tired, been a long day, and trying to scramble around, getting all the descriptions for the live session sorted last minute. This is the way I do things. I'm very spontaneous, so apologize for that. But anyway, hope everybody has had a solid trading day so far. It feels like it's been a bit of a weird one. This morning seems like we just plowed one direction, and a couple of hours ago we've reversed that whole move. I'm currently in on GU, Nasdaq, and gold, and it's the same story across all three. So we got an indices, commodities, and an FX pair there, all singing the same hymn sheet. So I'm not surprised coming into FOMC tonight. I'll probably cut my exposure before then anyway. At least two of my strategies will do that by that time. But yeah, just a bit of a weird one. And then you'll probably find that on the news drop, it'll probably tank a little bit and then continue in the same direction. So anyway, today we're going to get into a couple of things. There's something that I want to go over to begin with, which is something that we spoke about in yesterday's session, I believe, maybe a session last week. I've kind of lost track at this point, which I think is really important for us to go over. And then we can take a look at strategy development, strategy building, all those sorts of things that we do in these sessions. Keep it lighthearted, keep it fun. And I will answer any questions that you guys have as we go through the session. How we doing, dude? How are you? Is that tan? It's tan if I'm not mistaken. Sorry if I've got that completely wrong. But I'm sure you said it was tan last time. Looks like we're live on all channels as well, which is fantastic. Okay, so initially what I wanted to cover was something that we discussed again. I think it was yesterday, but it could have been late last week that we went over this. But people have started noticing that there is a new investor coming through to Darwin, specifically Darwin's in DarwinIA GOLD. And that investor is called DarwinIA Hedge Zero. Essentially what this is, it's not another investor in terms of, a normal investor, somebody who's invested or allocated capital to your Darwin, or Darwinex allocating capital to your Darwin where you earn performance fees. It's not that at all. The way that this works, and what it is to be precise, is that when we're looking at DarwinIA, this is all virtual, right? The hedge fund, the proprietary fund that we have, and investor capital, that is all live capital that is backing your trading. So when you have investor capital, it's like I say, true live capital. There's actual orders going into the market. It's 100% legit, right? With DarwinIA, that's basically a virtual allocation. So the process is all the same, still runs on a live market environment, but we're providing a virtual allocation. Now, with that, of course, and we're fully transparent about this, that adds risk to our books, okay? Because we're making a commitment to traders, and specifically good traders, right? Because when a trader goes into DarwinIA Gold, the allocations that we give last for 6 months, and they are, they go up to 500K per month. So a trader can scale quite aggressively through DarwinIA after a period of 3 or 4 good months. And whilst that's great, the issue with that from kind of an operational perspective is that we make an oath to pay that trader, X amount of performance fees down the line, even if the allocation is virtual and, there's not real live capital there backing that strategy, right? We still have to pay the performance fees. And so what we've done as a step towards reliability and efficiency of making sure that we will always be able to make those performance fees, regardless if we have 10,000 traders, 100,000 traders, or 1 million traders, is we've started hedging the exposure that we have in DarwinIA. Now, this is exactly where DarwinIA Hedge Zero comes in, is where you see an investor step in with that name. it will. How are we doing, Vincenzo? Hope you're all good, dude. If you have 100,000 euros or $100,000, sorry, in DarwinIA, no, euros. If you have 100,000 euros in DarwinIA allocation, what we will do as of right now is we will hedge 66% of that exposure. Now, of course, you would only be earning 15% performance fees. So we're basically looking at 15% of 100,000 euros, and then we would hedge 66% of that. Potentially, in an ideal world, maybe we will hedge 100%. But as of right now, we're still in the testing phase of seeing, is this going to work long term and putting it into practice? Okay. So let's say 3 months down the line from your DarwinIA allocation, you receive a payout of $4,000 or $5,000. Now, if it's a virtual allocation, that $5,000 is directly out of our pocket as a business because it is a virtual allocation. It's the way that the model works. Same as any funding company, right? There's no true capital backing it, and you're basically paid out of the pocket of the business. With us implementing the DarwinIA Hedge Zero, the capital that is made or the profit that is made with that investor capital pays directly the performance fees, which for us as a business makes the model way better for long-term growth and sustainability. Because if we have to pay $100,000 per month and that's coming out of our pocket, well, that's a large cost, right? Whereas if we can upfront allocate a load of investor capital to hedge that, and instead of paying $100,000 per month in performance fees, or however much it is, I'm just plucking these out of thin air, we're paying $66,000 out of what we've made on the hedge account. So our true cost is what, $34,000? That reduces our costs a lot, which means we can expand DarwinIA, means we can invest more into traders, means we can grow the business more, means that every single trader gets a better experience at Darwinex. And not only that, it's better for, this is kind of a side benefit, right? And I talk about this a lot when people ask, what does an investor look for in Darwinex Exchange or the Darwinex marketplace? And I always say performance is number one, right? You can't ignore good performance. And that is the first thing that an investor is going to look at. Okay, how does the trader perform? And, how do they recover from a bad period or from a drawdown? But actually, I think number one is something else. And that is getting your first investor. If it doesn't matter how good your performance is, if you don't have an investor, it's very easy for somebody to look the other way. And I'll explain why. Investors are sheep-like. They feel comfort in knowing that other people are exposed to the same things that they are. Okay, it's basic human nature. There's a lot of psychology behind it. I'm not going to pretend that I'm an expert in that field, but I know this is a fact. If I'm looking at two assets and the performance is, let's say the performance is relatively similar. Asset one has 100 investors and $1 million under management. Asset two has 0 investors, or maybe even 1 investor, but let's say 0 for now. They don't have any AUM, no investors, but the performance is the same. How are we doing, Rob? Hope you're all good, my man. Are you more likely to go for the one that has 0 investors, or are you more likely to go to the one that has 100 investors and $1 million in AUM? I mean, it's pretty easy. Even I would think this, you would think this, the majority of people would think, well, the other 100 people who've invested capital have probably done their due diligence. I'm happy to put my money up front because 100 other people have done so as well. So I don't want to be the loser.
Motion detected at the front door.
Alexa, volume down to 1. Gracias, mi amigo. I don't want to be the one investor who is sat on my own losing money whilst 100 other people are making money over here. Okay, if I'm the one that chooses a losing asset and I'm the only one, I'm going to feel like a mug. And because of that, investors tend to bunch together. And we saw this case in study is THA, right? We had THA, who was at his peak, I think about $38 or $39 million in investor capital. But there were Darwins that were outperforming him for a long period of time with much less AUM. But it's very easy to look at THA, who had 38 million, and the next trader who had 5 million, and go, well, I'd rather be comfortable with all of the people who've allocated to THA. And that's what we saw for years and years and years. It's one of the reasons we release the index, of course, so that we have fairer distribution of capital. But having that first investor come through and it be Darwinex is a major breakthrough for most traders who are struggling to get that first person to see the vision, to see you stand out over everybody else. In DarwinIA Gold right now, there's 410 traders, right? So that means there's 410 investable traders on Darwinex, plus anybody in silver who is from Darwinex and not Darwinex Zero. So there's a lot of competition. And if you're the one who sat there without an investor, of course, it's going to be difficult to get that first one to break that wall down and continue moving forward. Having DarwinIA Hedge Zero or Darwinex Labs come through and invest capital into you, whether it's hedging mechanism or whether it's an actual investment through the proprietary fund of Darwinex Labs, or even if it's Darwinex Index, so Darwinex Hedge Fund, that first investor can help spark confidence with everybody else. Okay. And it's not usually a small investment. It's usually somewhere in the region of 5, 10, 20, 25,000. So that allows people to look at your asset, look at your Darwin and go, actually, I'm pretty happy with that. I'm going to park a little bit of capital here as well. So that's the benefit. But the main mechanism of it is to be an internal hedging function. Okay. So we're allocating DarwinIA allocations out, which are virtual. But if we can back a certain amount of exposure with live capital, it makes a whole program more sustainable. So I wanted to clarify that to begin with, because I actually explained it different the other day. I think I got the wrong end of the stick. And then I had a few questions this morning. 2 seconds. I can hear my children screaming downstairs, so I'm just going to ask them to be quiet. Can hear her singing at the bottom of the stairs. She mustn't know I'm streaming. So yeah, I just wanted to clarify that so that if anybody did have any questions or anybody had received the emails that comes through from that, which is an automatic email where it's not cute, believe me, not when she's screaming the way that she is. Like I say, I had a few people message me privately this morning asking me why they'd received that email and what it meant, because the way that the email read was like, we're investing in your strategy, but we're not paying you performance fees. And I don't think the communication was as clear as it could have been. So I wanted to clarify that today. I think we'll probably send out another form of communication soon, just to clarify again for people who haven't watched this session exactly what DarwinIA Hedge Zero is. But it's a massive update for us, because it means we can put more capital back into DarwinIA, back into investor capital, into the index and into Darwinex Labs and stuff. And it makes DarwinIA way more sustainable for the long term, which is just fantastic. So anyway, let's jump into it. PWBV. Okay, I think I've got that bookmarked. Maybe I haven't. PWBV. Might not be bookmarked, but maybe we've done it. Maybe we've done it before. Dark Nexus. What a name. 161 out of 9,201 traders in silver. Fantastic work. It looks like you've had a good day as well. That's probably why you're here and putting your hand in to have your Darwin analyzed, right? 18.6% return, 4.99% drawdown. It's fantastic. This curve is super nice. Very, very stable. The only thing I worry about here is what do your drawdowns look like? And that's not being me being negative or saying that your drawdowns are going to be horrible. It's just we haven't seen it, right? It's the same with mine. Until you've had a decent drawdown, you never know what that trader's recovery factor is like. You never know how well they will recover. That's always my concern looking at a trader's record as an investor, is going, well, whilst their performance is great, I also want to see their worst drawdown or at least a period of like tough drawdown, for example. And I want to see how that trader works out of it, because that gives me 10 times the amount of confidence than looking at a chart where it's just perfect all the time. If it's perfect all the time, it makes me think that it's a martingale strategy or a grid trading strategy. In which position are you in DarwinIA? I was 37th, I think, but that may have changed in the last update that's just happened. I know, still 37th. Yeah, still 37th. Rob, I don't like being a C next Tuesday either. If you needed to go, you're welcome. I mean, we did SPWL recently, right? I'm presuming that you're still not trading it. You're still having time off till next month. But in fact, let me check. SPW. When did you say to me? Where are we? Rob. So you told me on the 27th, which was 2 days ago, I'm going to come back in the next month. So you told me you wasn't trading until next month, yet you're up today, which means you're in a position. Rob. Naughty. That's not what I expected. I mean, it's all good because you're up for the day, but you did tell me you wasn't going to trade, so you need to check yourself. Upcoming drawdown in the future. Let's go. Yeah, I mean, the great thing is about drawdown, right, is when you come out of it, as long as it's not, again, like a martingale drawdown where we have an equity curve like this, and then see, let's get a big pen. If you have, come on, here we go. If you have an equity curve that just looks like this and then does that, and then carries on, like this is just a clear sign of martingaling, and that's never a good sign. Like if you have this period, then you can pretty much say bye-bye to the majority of investors. You will always get investors, but the majority, because they know that this is kind of, it's like you're standing on the edge of a cliff, right, and waiting to fall off, basically, because they know that this could happen at any time, and it can happen very, very quickly. However, if your curve does this and then has a period of drawdown like this, and then comes back to new all-time highs, like, oh, that line is a little bit shaky. Like, I know that this period doesn't phase you. And that if I'm sitting through this drawdown, I know that you're still focused on the end goal because you've managed to recover. Like this recovery is something that not a lot of traders focus on, but being able to not just restart, cut the account and start again, you know, because that would look like this. If a trader goes through drawdown and then starts again, they're basically doing this every time, okay? And then just cutting it, starting again, cutting it and starting again. And what I would like to see as an investor, and I know that a lot of investors are the same, is that deep, not necessarily deep drawdown, but a drawdown where the trader manages to recover. Naughty. Alain, thanks again for help today. It's an absolute pleasure, dude, and looking forward to being gold. Yeah, if this goes out to anybody, right? My direct messages, my email is always open to help anybody with any issue that you have. Sometimes it can take me, you know, a few days to respond, and I apologize for that. I'm a busy guy, but I will always get back to every single person who messages me. You know, like I say, it might take me a few days or a week even sometimes. But if it's an urgent issue, you can always ping me or remind me or send me another message or email, and I will always get back to you. So yeah, that's kind of my message to everybody. You can always feel free to reach out to me. Legend AK, naughty. Yeah, Rob is a naughty boy. Vincenzo, yes, thank you. I like to listen for XAU USD. I am 1,450. I don't like martingale or breach capital. Yeah, I do martingale, but I don't increase my lot size, which I believe is called anti-martingale. So will it work? It's more grid trading, I guess, and I mean, yes, it works until it doesn't work. I mean, I suppose grid trading, the majority of grid traders still use martingale. And like I say, it works until it doesn't work. I have a grid strategy running, and it does use martingale lots, running on one of my test Darwin's BYXB, and this is pound sec. So I've been in this. Now this is a carry trade. Okay, so I trade with positive swaps on this. I grid trade into it, and each one of these is a H4 candle, right? So I've been in this position for months now, and it's just going against me and against me. And realistically, that's not even a big move. I mean, I guess it is. It's a few hundred pips, but it's not a major move. This could very, very quickly spiral out of control. I know that. This account started as a test account, and then I ended up just keeping it open. I know that this strategy has extreme risk, and it does, and it kind of works until it doesn't work. Okay, so just bear that in mind. I'm not saying that you can't make money grid trading and martingaling, but just just be aware when things get bad, things can get really, really bad. What's your value at risk like? It's not too bad. The perfect example of this is what I'm sure most people have probably heard of is Waka Waka, which is a martingale strategy that trades Aussie CAD, New Zealand CAD, and Aussie New Zealand. Now, when you look at the balance chart, this is exactly what I said. It's just that steady growth. Let's remove all of this rubbish. Okay, can we make this any bigger? Okay, so when we look at that balance chart, you're like, that is one of the most stable things you've ever seen, right? Just up, 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 up. And that's from June 2018. So how many years is that? 19, 20, 1, 2, 3, 4, 5. So it's a 7.5 year track record, right, where it's just up and to the right. Now you look at this and you go, well, what happened there? Why was there such a big return? Now, if we turn off growth and we put on equity growth and we go, okay, so they basically almost blew the account at that point. I know this because I was trading this at the time, so I had some money in this EA, not a lot, but some, and it went on I actually think it was higher than that. The drawdown, I think it went 70%, but I think this has changed based on the new return. Perhaps I have no idea, but the point is, before this, I think the max drawdown was like 10%, 11%, somewhere around those figures. And it had been that way for 5.5 years. And then all of a sudden, bam, 66 or 70% drawdown in this matter of like weeks. And this is exactly what I said is when I drew that curve, this is exactly what I said, right? Let's get rid of that because that's not the right color. Where it just goes up and then boom, like that. Because this, especially if you're trading that, with a little bit more exposure, can just blow up an account straight away. You just blow it up. If you don't have enough margin in the account, if you're trading with lower leverage, you can, basically lose everything. So that's the risk of trading with martingale or grid trading strategies. I mean, Waka and the majority of martingale system or grid systems do increase their lot size every time they get into a new trade. If you don't, I guess you don't run as high of a risk in terms of experiencing this kind of drawdown. The problem is with what you have is if your chart just looks like something like this and price is just coming down and down and down and down, and you're buying, you need price to go so far up just to break even or take profit on a position. So you can end up being in kind of a period of stagnation for months, if not years. The thing with martingale is the target reduces every time because they're adding size, right? So the curve will just go up and up and up until you get this blip. If you're just grid trading, you might find that you're sat in a position for months because you need it to, keep going in the opposite direction. And if you find that, let's say the yearly candle looks like this, and you've been buying that whole way up, what happens if it doesn't trade up there for another 10 years? Are you going to be sat in that position? That's the problem with grid trading. I'm not saying that that's going to happen, but it's something to be aware of. My strategy is like week in Fibbo retracements. Every week I put an order on 0.6 and 0.7 Fib. So yeah, if I'm in floating loss, I do enter the trade. Do you exit the trades as well? Because if you exit the trades, that's completely different. Whereas if you're running them without stops, that's the concern, right? That's where you see those the kind of drawdown spiraling and the risk spiraling. Whereas if you have stops on your positions, then grid trading actually might not be a bad play, dependent on your strategy. For example, let's say your target is here, your stop is here, and your original entry point is here, and price keeps going against you. Maybe this is over the course of a week, and you just keep bidding, but you keep your stop there. I never exit the red numbers. Okay, that's what could kill you. that's what could kill you, because if you don't exit a losing trade and you just keep entering, well, the market can remain, what's the saying? The market can remain irrational for longer than you can remain solvent. And what that means is the market can just keep pushing in one direction for longer than you can withstand, financially. The other issue that you have with this, and this is very rare, so it's not like a real issue that you should be concerned about every single day. However, I'll give you an example. If we take a look at Euro Swissy and we go, okay, so let's put this chart into context. This is a Euro Swissy, okay? So each day candle, average, you're looking 3 pip ATR, peak to trough, let's say 23 pips. Okay, so a really, really low volatility pair. If you're grid trading this, let's say you're just buying as it comes down here, and you're waiting for price to come up here or waiting for price to come up there, which again, people do, especially in this example, people did, because effectively what was happening, and you can see it over here, is that, and this is a bit of trading history for those who don't know this story. So the Swiss National Bank was holding the peg, so it's called. They didn't want Euro Swissy to fall below this price level of 1.2. Yeah. So you can see this is not natural price action. Bear in mind, these are all daily candles. This period of time was 153 days. So, pretty much almost half a year. Of just trading down here, the SMB just buying it up, holding the peg, supporting the floor, and making sure price doesn't go lower. Now, what happens over here? On this day, the Swiss National Bank come out and say, we're no longer holding the floor. We're going to drop the peg. And then, okay, so average candles over here. In fact, let's just get the ATR. Seems I've already got an ATR up. ATR over here was 14 pips per day. Okay, the average true range, 14 pips per day. On this candle, when they abandoned the peg, let's see how far it went down. Now let's put that into perspective. 2,268 pips it tanked in one day. Now, what happens if you were long up here, regardless of whether you had a stop on or not? Because I know for a fact on this day, when they abandoned the floor, on this day, they were giving revised slippage out. So you might have been long with a stop below the floor, because it would have been smart to do that, or above the floor, I should say. It would have been smart to do that, because you go, well, the S&B are going to buy it here, right? So price is obviously going to go up, and I'm going to put my stop just below the floor, maybe, so that I want to be first out in case the market dips below it. But actually, what they were doing is the brokers were calling up clients and going, well, actually, we couldn't fill you at that price because there was no orders there. There was not enough volume in the book. So what we did was we actually filled you all the way down here. That's the price you got out. Oh, and by the way, you owe us 10 grand because you've been slipped and, you lost 10 grand on that trade. The problem with grid trading is you would just blow up your account straight there and then. Yeah, that was the trade that took out Alpari and many trader funds in the broker. Scary day. Super scary day. I mean, 2015, how old was I? 2025. I'd have been 20 at the time. So it was the year before I started getting into crypto. So I wasn't even in markets at the time, but I know a lot of people who were, and the story of this just blows my mind till this day. Like, I don't think I've seen a crazier candle than that, really. Exactly. So the legend said that's going to be the nightmare for people who believe in a grid strategy. And the problem with that is, yeah, Tom Dante has a story about that day. That's correct. Because he actually got filled. The brokers filled him at his requested stop. So his stop, if I remember right, Tom's stop was above the floor, with the idea of so he was long on the actual day with his stop above that floor, with the idea of, if this was to happen, I want to be first out, not last out. Because obviously, if there's 10,000 traders long there and they're filling them one by one, if the order book is empty, or you want to be the first one out because you want to have the highest quote price. And his broker actually filled him at the price that that he put in for his stop. But I know for a fact people were getting calls later from the broker saying, we've revised your slippage, you've been filled down here, and basically it was a lot of money. And it's quite a humbling experience, even if you haven't lived through it, because you go, okay, this could happen at any time. We see it with Trump now. Trump comes out and says something random about tariffs, China, whatever it may be, and all of a sudden the market goes bonkers. We see it time and time again, yet people don't realize the risk of having a black swan event. Not the fact that it's not very likely to happen, and these things don't happen very often. You have things like Brexit, COVID, the S&B abandoning the peg, Trump talking about crypto or Trump coin, stuff like that, right? It doesn't happen very often. But if you're exposed, and if you have too much exposure and you're not having a stop, or you don't close trades in the red, it can kill you. And it only takes one of these times to kill you and your career. And that's the worry, is it doesn't matter how many of them you've survived in the past, it still only takes one. That is my honest opinion. I mean, there was a super long and roundabout way of talking about grid and martingale trading, right? But that is the one thing that scares the bejesus out of me about grid and martingale strategies, is that they can work for 5 years, 10 years. They might work for a month. Who knows? But eventually they will most likely meet their doom, because nobody is bigger and badder than the market. Hello, Kieran. How are you today? I am very, very well, my friend. I hope you are too. I missed quite a few messages there. Rob said, "What's waka waka?" hey, it's time for Africa. Yeah, so waka waka is either a bit of Shakira, or it's an expert advisor that basically martingales on a triangular system between New Zealand CAD, Aussie CAD, and Aussie New Zealand. Vincenzo, I prefer to enter more clean in swing strategy and buy long with stop loss at break even, no loss, no martingale. I mean, the in an ideal world, if you're managing capital on behalf of people, you should always have a stop. Always have a stop. Because it protects you from things. I mean, it might not protect you from this, but don't take the obvious trades is the lesson in this, right? It's easy in hindsight, but if it looks super obvious, do not take that trade. Like if your whole premise is, the S&B should, they'll hold the floor, that's too obvious. Like, don't do it to yourself. But yeah, I used to work with a lot of funds and connecting them with traders before my time at Darwinex, and the first thing they would always ask the traders is, do you implement stops? Do you martingale? And if the trader goes, no, I don't use stops. Yes, I'm martingale. Oftentimes the conversation was cut there, then and there. I've just realized how much of a stunning level that is. Look at that support, turn, resistance, absolutely stunning. 3 years later, 4 years later, 3 years later. Yeah, Jan 2015. That's April 2018. That, you couldn't get a better trade than that. But yeah, that's my fun story time for the day. So what do you think with the commodities? Will this kind of pairs fall for months? No, right. So that's where I can do this strategy, isn't it? Okay, let's do story time again. Let's take a look at crude oil. They don't quote negative on this chart. WTI. Let's see if we can get a chart that quotes negative. Interesting. Crude oil futures. Let's take a look. Here we go. So we're looking at crude oil futures here. Okay. So this is during COVID, right? Again, it's a black swan event, right? But you've asked me for my opinion. You've asked me to be honest. I'm telling you worst case scenario. This line here is the value of 0. This means $0 per barrel of crude oil. Okay, let's make that white and let's make that a nice big text. That's what that line means. Okay, now if you were gridding here and you were martingaling, whatever you're doing, even if you're just long at this point, what happens when the price of crude oil goes negative? Bear in mind, we're on a daily time frame again, so this is a period of a month. Okay, so for a month, crude oil was spent in the negative or negative value, which means if you were long crude below that level, you actually owed them money, essentially, in a weird way. I mean, what you should have been doing at this time is buying up all the oil that you could. But of course, I think I bought somewhere at like $5 and thought I was a genius because I was like, this has got to go up. Obviously, crude can't become worthless. But then the contracts, because remember, even if you're trading the futures contract, you're not actually buying oil. You're not going to a gas station and filling up your jerry cans of oil and taking them home, or you're not going and digging for crude and actually getting the oil that you can kind of store. You're buying a contract of, and the contract goes negative, meaning you need to kind of pay us to hold this contract because the contract is negative value. But the idea here again is that you could just get smoked on this, completely dead. Okay, you could lose everything just on that one move. So that's my story time about commodities. Again, it's a black swan event. It doesn't happen that often. But to answer your question about commodities not like trending for months, I mean, this is a pretty harsh trend. This is a pretty harsh trend. This is a pretty harsh trend. I mean, crude is notorious for just being an absolute bugger when it starts to trend. Like, I wouldn't want to be gridding in any of that. I also wouldn't really want to be gridding over here where price just isn't moving, really. I mean, maybe that's a bit unfair. Maybe if we zoomed in, but then that's a bit of a bugger to do. Maybe this kind of period here is the ideal time to be gridding because you're just trading that range, basically. Going to remove all those because if anybody joins, they're going to think that we're doing some pattern stuff, which we're not. I'm TRFF DarwinIA. I thought you had a 3 ticker, Darwin. You could blow up as an intraday trader, 100%. Similar to what happened in crypto recently with people not having stops on it. Yeah, I mean, crypto is notorious for it, right? If you take all you got to do is take a look at Binance charts. Let's use XRP because I know that went absolutely nuts. Binance, like, what price did it get quoted at? 77 cents. XRP was quoted at. Bearing in mind that as a market cap is just incredible. That's like billions wiped off the planet for like minutes. If we drop down, so it got quoted there for like less than 5 minutes, probably less than a minute, to be completely honest with you. Oh my life, how far back are we? I can't even go about that far. So yeah, there's so many examples where the market will just humble you. Again, we've looked at an FX pair, we've looked at crude, a commodity, we've looked at crypto. Like this, the markets will humble you at any opportunity that you give them to. Okay, going back to the quote that I used, the markets can remain irrational for longer than you can remain solvent. You are never, and this doesn't go directly to you, Legend. I'm not saying that at all. I'm just saying in general. You are never bigger, you are never badder, and you're never cleverer than the market. The market can and will wipe you out. I actually made an interesting post the other day, a couple of days back, talking about my exposure in my multi-strat portfolio. And I said, if you look at the data on XAQP, I'm in the market for just over 8% of the time. That means 90%, 92% of time, I'm sat out of the market and I'm completely flat. For me, that gives me so much peace of mind because that means I have such a low chance, not zero, but such a low chance of experiencing any of that. What on earth is this? Any market crashes like that, because I'm only in the market for 8% of the time anyway. Okay, I run really low risk and I'm not in the market very often. Plus, I don't take obvious trades, right? So it's about minimizing the risk of experiencing something like this, even though it doesn't happen very often. But back to my point is, it doesn't have to happen often. If it happens once, it can just kill your career as a trader. Again, somebody mentioned Tom Dancy. Tom has some great stories of people whose career was ended within like minutes, of making a bad decision, or not even making a bad decision. He has a story about a woman who was a trader, and she'd made a lot of money. And I can't remember exactly what happened, but I think she was long the FTSE or long something. Again, I can't remember. And she was on the phone to the broker trying to get her out of the position. And basically what she was doing, she was clipping the position to close her trade. But what happened was the text she was using didn't show that it closed the position, so showed it was still open. So she kept clipping it. And basically what she was doing was, the first time she'd done it had closed the position. And what she'd done is clipped it like 5 or 6 times more. And what that had done is then clipped her in the opposite direction. So then she was like 5 times her original size offside, and she was short. So she apparently got up, left the office, and never went back. So ended her career completely. And that's because of a tech issue. That's nothing to do with charts and market pricing and stuff like that. So again, you have to just be super, super cautious and careful, and know that anything can wipe you out at any given time. And your job is not to be a trader, it's to be a risk manager first. If you have a solid strategy that has a positive expected value over a long horizon, let your strategy do its thing. You haven't got to step in and try and make trades work, or try and milk the market for what it is. If you make money, great. But that's not your job. Your job is to build the strategy, let the strategy work, and then you manage the risk and the exposure on your end. That's the only thing that you're actually in control of. As a trader, you're not in control of the outcome of the trade, but you are in control of how much exposure you have at any given time. 3.7% drawdown, but not use EA usually. Use indicators and price action. I think the best strategy is to have the best managing of drawdown, not over trading. Exactly what I've just alluded to. Yeah. My nightmare, but there is not much you can do if this case. In this case, if your stops is not filled, do you have any advice on how to avoid that as an intraday trader, or is it just you need some luck? You definitely need some luck. It's legend. See you later, dude. I've only just seen your message. You definitely need luck. Specifically with these sorts of cases, like I would argue with the Euro Swissy case when the S&B abandoned the peg. Like I say, it's easy to say in hindsight, but if it's an obvious trade, you probably shouldn't be taking it. So I would say you definitely need luck. I've survived. I don't really do much in crypto anymore, but I used to, and I survived a lot of crypto crashes. And then I had one, and I lost a lot of money. We're talking multiple 6 figures of cash that I'd made the year or two prior to that, and it was gone in an instant, and it completely wiped out everything that I had. I was reckless. I was young. It is what it is. And looking back, I'm kind of grateful for that experience because it taught me so much about risk management. And I think I was young enough to have the grit to carry on moving forward and learn from those mistakes. But you definitely 110% need to be lucky and need to not be unlucky as well at the same time. For example, I lost about, I think it was about £40,000 by putting capital into a platform that I was meant to only put in there for like 2 days. For anybody who's well versed in crypto, I had about 40k staked on the Phantom blockchain, and there was rumors of somebody who was heavily long and they were about to get liquidated, and the rumor was, if and when they get liquidated, there's basically going to be zero liquidity on the Phantom network. And so I was panicking, thinking, well, I don't want to lose 40k. So what I'm going to do is I'm going to pull it out because he's very close to being liquidated. So I'm going to be first out, not last out. I'm going to take my 40 grand and I'm going to put it into Anchor Protocol, which was on the Terra Luna blockchain. And I'm going to hold it there for, maybe a week. And then once this guy's liquidated and once things are back to normal, I'll move it back to Phantom. What happened 2 days later? Terra Luna blew up, and that 40k was, I think at the end of it was worth three grand, like literally 24 hours later. And so that was a case of me trying to be smart and trying to avoid something bad that I knew could happen. And I was just super unlucky that I did it right before this crash happened and, you know, lost a load of money. So you absolutely have to be lucky, and you have to be not unlucky. You have to not be unlucky. I think they're different things, right? You can be lucky and you can be unlucky. I think they're completely different things. I've been doing some research since we discussed yesterday. Algo trading makes more sense to me. I want to ask you, since you're doing algo, how do pros backtest and how many years? Completely depends. Depends on the person. I like 8 years is a sweet spot for me. So sometimes I will check further than that, like 10 to 15 years. But in my opinion, a lot changed from pre 2015 to after 2015. You know, access to markets got easier. They got more efficient. Like market caps of the US stock market is like quadrupled. If you're looking at NASDAQ like 8 years ago, you're looking at prices or quotes of like 5,000, 6,000. And I think there's a point, and people disagree with me on this, and that's absolutely fine, because the whole key here is that we don't have to do, not everybody has to do the same things, right? But I see people and they'll backtest strategies from like 1950. And they'll put up an equity chart from 1950 with an 11,000% return, and they'll say, this is what this has made since 19. And I'm like, but you wasn't born in 1950, so it doesn't really matter, right? Because you're going to have to be 90 years old to have been trading that strategy. So it's kind of irrelevant. The markets were, there was no electronic markets at the time. Liquidity was far lower. Volume was far lower. Market caps were far lower. Like access to markets was basically non-existent unless you were a professional or institutional trader. And it's kind of like, are those conditions exactly the same as what we're seeing now? Absolutely not. So does it make sense to be testing that period? It baffles me that people think that that's something that they should do. So sometimes I will take out of sample data, and I will sometimes go back prior to 2018. But my sweet spot, and this is just what I prefer to do, is 2018 up until current price or current date, and that's my final back testing period where I go, okay, that's where I make a decision. I won't do it any shorter than that. I won't really do it any longer than that. Again, sometimes I might test further back if I have the data for it. But my final kind of check mark where I go, yeah, I'm happy that performance is from 2018 to current day. That's my opinion. Other people will have different opinions. But again, you have to look at, you have to have enough data to be able to test different periods of growth, stagnation, deflation, different precedents, different interest rates, all of these different things. You need different market conditions, right? But also what you don't want to be doing is taking data that just is completely irrelevant. Again, like, do you want to be, let's say, and I don't know the actual numbers here, so I could be talking out my rear end, right? Is 30 years ago, let's say the volume per day on gold was, I don't know, $100 million volume per day. And then let's say today it's 5 billion. Are the strategies going to work the same on that difference in volume? It's a completely different market. I said this for years in crypto, and nobody agreed with me. And again, that's fine. But people would look at a logarithmic chart. For example, let's just go Bitcoin. And then let's go daily time frame. Where are we? Where's the log chart? I don't even know how to set it to a log chart anymore. Logarithmic. Here we go. People would start looking at a logarithmic chart, and they would compare this period, for example, with this period, or this period with this period. And I would say, like, when we're looking at this, price action might be the same, but Bitcoin was $400 a coin at that point. You cannot say that the market is the same as when Bitcoin is 20K or 60K a coin. It's a completely different dynamic. With the price isn't just some random value that somebody's picked out of thin air. It's the circulating supply and the amount of money that's invested, right? So the price per coin times circulating supply equals the market cap. The market cap's completely different. You're probably looking like 100,000 market participants compared to 1,000 back when it was $400. Again, these are just random numbers. The variables are too different. It's not comparable, which means what's happening down here is completely different to what's happening up here, is completely different to what's happening up here. Okay, because the variables are so different. And I used to say this to people, and I mean specifically with Bitcoin, people would go, "Oh yeah, but bro, it's the cycle. This is what happens." And I get that. There's a kind of a self-fulfilling prophecy with crypto, which we won't go too much into when it comes to market cycles. But it's the same with anything. Okay, like the market does a unique thing in that given time and date. The participants might remain the same. The price action might do similar things as in the past. But gold is now $4,000 per ounce or what have you. Does it do the same thing that it did when it was 500 or 1,000 or 2,000? Of course not. There's more buyers now because, well, the asset's gone up in value, right? So it's a completely different market. Anyway, rant over. So in my opinion, 8 years is the complete sweet spot. But again, people will have different opinions, and that's absolutely fine too. What exactly did you do at a hedge fund before Darwin? So I didn't work for a hedge fund. I have a good network of capital allocators and hedge funds and private funds. And I would basically refer traders to them. So I would take traders who I knew who were, I would say, profitable for a period of time, and I would connect them with a hedge fund. They would start trading with them and scale them over time, and I would keep a percentage of the performance fees that they made. I didn't make much money doing that because not many traders could withstand it, but hey ho. When can we expect platinum and palladium to be added to MT5? I have no official date on that. I can only apologize. I'll push back to the team and see if we can get them added. But yeah, I don't have an official answer to that. What do you use to build the strategies, and what do you aim for? Low VAR and high return. Also, when do you know it's time to cut the strategy off, and how do you manage those strategies? Okay, so that's quite a big question. So I use FX Streamer to build my strategies. I don't really aim for, I mean, yes, overall I aim for a low value at risk. I don't aim for a high return. If I bring over my MetaTrader, this is my master account for XAQP. You can see my return after 7 months is like 6%. Okay, so it's nothing major. My return on my Darwin is like 30%. So I'm scaled up quite aggressively. So I would rather run with a really low value at risk, see small numbers every day and be okay with it, and let Darwinex scale me up. Okay, I'm completely happy with that. It works for me. How do you know when it's time to cut the strategy off? I have a few different metrics that I look at. So max drawdown being the one, or one of them, where I would go, okay, well, in the past 8 years, the max drawdown this strategy has been on, and remember, 8 years is kind of my period where I'm most focused on. So through those 8 years, the max drawdown this strategy went on was 1%, because that's how I tune my portfolio. Every strategy has a 1% max drawdown over that time. If it goes above 1%, I'll then look at the next metric, which is, okay, how many losing trades has it had in a row? Because previously it might have been 10. If we're at 12 losing trades now, I go, well, it's a new max drawdown and it's a new consecutive losing streak. At that point, I'm debating whether to take a look at the strategy or well, I'm not debating. I already am looking at the strategy at that point. It hasn't happened to me live, in terms of none of my strategies have had this happen to it, but this is a process that I have anyway. And then I start looking, I'll run all my same tests, including the live data, and I will do the live data is kind of an out of sample performance period, and I'll compare the risk metrics, so my Sharp, my profit factor, and that sort of stuff, from the out of sample to the in sample data. How is that just, I swear that's just slipped me on my stop. Unless I may have, do I have a specific closing time on that? I can't even remember. Seems weird that it's just closed me there. Must be. I think I must have a specific closing time on that trade. Anyway, back to my point. If the risk metrics look completely different, let's say before it had a profit factor of 1.4, now it's got a profit factor of 0.8, I'm going to be going, okay, I don't really want this in the portfolio anymore. So I'll keep it away. I'll revisit it in the next quarter and go, okay, what happened in this quarter? Did it continue its slide? Therefore, the strategy is kind of broken, or did it recover? And now I kind of need to scale the risk back, because if the new max drawdown is 1.2%, but the risk metrics are okay because it did recover eventually, well, I'll put it back live, but I'll reduce the risk so it's back to 1% max drawdown. That's my process anyway. But again, there's no right or wrong answers to that. You might want to cut strategies quicker than I do. You might want to give them a bit more time to continue. I hit stop on both a short and a long on gold today. Whoa, what an absolute joke. I thought I'd hit target on a trade earlier. Mustn't have done. Okay. Vincenzo, oh my god, no, I don't have any open positions, for example. I was waiting for the best range of gold. Elaine, oh my god, yes, I was there during Luna, my early days. I didn't know what I was doing, rode it up and got out just by luck. I have avoided many black swans in crypto for now. Yeah, I also rode Luna up. I think I initially got in Luna at $3 or $4 and I started selling it at 30, I think. So I made a lot of money on it. Same with a lot of crypto in that time. That's where I made a lot of my money. But then I lost a lot of my money in the following year in black swan events. I just got hammered. And so, yeah, I avoided all of those black swans until the one got me. And when the one got me, it was bad. And yeah, I pretty much lost everything that I'd made and more. So I am an expert risk manager now because I have lived through losing. When I say losing everything, I genuinely mean losing my entire net worth pretty much. Like I say, it's stupid. I was young, I was reckless, and I had the majority of my net worth in crypto. We're talking multiple six figures. Again, I'd made in the previous year through crypto, and I lost 98% of it. And so I had to rebuild from day one, and we're here 4 years later. And, you know, we survived, and I'm super grateful for that lesson because it makes me a better trader and investor these days than I ever would have been without that lesson. SD, hey, how we doing? I reduced my position sizing, but my Darwin risk multiplier is still 0.41. My index is ZLEO. PS, I changed my avatar after your 666 comment. What's 6666? What's 666 comment? ZLEO. Vincenzo, see you later, dude. I hope I haven't missed you. I'm supposed to be, I think we're having a chat next week anyway, aren't we? Okay, your value at risk hasn't really changed, so I'll just give it some time. Your VAR takes the previous 45 days trading history and previous 6 months trading history into account for an average. So it can take a month or so for you to really start seeing it change. It's like you're chipping away every day at the average. I would just ask, what is your end goal of reducing your value at risk and increasing your multiplier? Personally, I don't think you need to. I don't think you need to reduce it, because is that better? Now you can actually see me. No, I got a white screen. I talk about this a lot, right? Your Darwin is optimized for the risk level that it's gonna be, regardless of what size you're trading on your MetaTrader account. Okay, and what I mean by that is it's a self-balancing mechanism, right? You've got your value at risk, you've got your risk multiplier, and you've got your end result, which is your Darwin. If you reduce your VAR, it's going to increase your multiplier, but your Darwin's still going to come out the same result. And the easiest way I can explain that is, if, let's say, you're risking $1,000 every trade, right? And you have a risk multiplier of 0.5 because your value at risk is 13, let's say. So you've got a 0.5x multiplier and you make a 1 hour trade. So you make $1,000, okay? No, sorry, you make $500 on your Darwin. You've made $1,000 on your MetaTrader, but because you have a risk multiplier of 0.5x, your Darwin makes $500, which might be 0.5%. Okay. Now, let's say you reduced your VAR and you increased your risk multiplier to 1-to-1. Okay. Now you've still made a profit, but because you've reduced your size by half, you've now only made $500 on your Signal account. But your risk multiplier has gone up to 1x. But what's 1x of $500? Still $500. So regardless of what your VAR was, regardless of your risk multiplier, your Darwin still came out at $500 anyway. So you don't have to get caught chasing your tail trying to increase your risk multiplier, because it will not benefit you in any way, shape, or form, especially not at a value at risk of 13%. So don't spend too much time focusing on it. Just trade the best you can and let the risk engine do its thing. Do not be too concerned about what your risk multiplier is. That goes for everybody as well. A lot of people have an obsession of getting it to 1x, but I always say to what benefit? It's literally not going to benefit you doing that. So you have to kind of be careful not to get sucked into the game of trying to get it to 1x, because it's not going to do anything. Yeah, that's some crazy mental strength to rebuild after losing it all. Yeah, I mean, I had a 1-year-old at the time. She's now 5 soon. And my missus was pregnant. Like, we're talking pregnant. She was ready to pop. So I had a lot going on in my family life, and then we got broken into, and that was a whole different thing. And they come upstairs in the house. I've got a Rottweiler, so she scared them off. And after that, we were kind of like, this happened like the same week that I lost all the money. But it put into perspective of like, oh, well, money comes and goes. Like, there's more important things in life to be worried about. So we overcome the loss of the money really quickly, because we were like, we had so much on anyway. And then when the burglary happened, we were kind of like, well, we're here, we're alive, who cares? Like, it is what it is. So as horrible as it was at the time, and I would never want anybody else to go through that, it's kind of like a blessing in disguise, because it completely masked any pain that we would have had from losing that money. It was like ripping off a plaster. Do you have all the strategies for prop firms, or do you scale down the strategies and maybe focus on a few? How do you manage these prop firms compared to, example, Darwinex? Yes, I have XAQP running on FTMO accounts. I actually scale them up for the prop firms because I run them so low risk. On Darwinex, it would take me like 3 years to pass them. So I run them at 3x risk, I believe. So yeah. The problem is with prop firms or funding companies, I prefer to use the name for, is you have to be super selective about who you choose, because I mean, a lot of them are just bucket shops, right? They don't have enough money to pay out, and it's kind of just a loser's game. But a lot of them won't allow EA trading. A lot of them won't allow you to trade through news, hold overnight, hold over the weekend, all that sort of stuff. FTMO swing accounts are perfect because you can do all of the above. And it's 30-to-1 leverage, so you don't need crazy leverage. And that 30-to-1 leverage is fine for me, even on 3x risk. So that's how I approach funding companies. I probably won't ever go with anybody else other than FTMO, to be completely honest. My focus is scaling that up and and getting FTMO Prime. Even if it takes me a year and a half, I don't really care. Is what it is. All good things take time. Oh, I can't even remember what the saying is. Good things come to those who wait, basically. So yeah. Rob said, I bought Bitcoin back in 2015. I left it until last year. I ended up with nothing. Could have had more, but 1K I'd invested was UZTech. Big Ponzi scheme. Also brought XRP in 2021. Lost my ledger password. Oh, God. Yeah, I've still got my ledger somewhere. I don't know where it is. It's got nothing on it. I have zero crypto these days. Kind of scorned from what happened. But yeah, that's never good, losing your ledger password. My biggest play was Cardano. I bought ADA. I've got a wallet somewhere. I think it was on Bittrex. I think it was on Bittrex back in 2017 or 2018. I was buying ADA at like 0.005 cents or 0.008 cents or something like that. And I had somewhere between 15,000 and 20,000 Cardano tokens that I'd spent like $1,000 on, and I sold them all above $3. So that was like, for me, that was a life-changing trade that allowed me to quit my job years and years ago, and start trading and investing full-time, which I did for 3 years. But yeah, again, I lost all that money eventually. So that's why I don't mind. Like, if I still had that money, I would never tell these stories, because I wouldn't want to be seen to be bragging in a certain way, but also like I wouldn't want to put myself at risk, being like, oh yeah, I've just made 100 grand and it's sat in my bank, or it's sat under my mattress. You put a target on your head, but the fact is, I'm happy to say, because I lost it all anyway. So I think matching VAR is just convenient for reflection of trading performance. Yeah, I agree with that. A lot of people want to know what VAR means in relative to how they approach the market. Nala, shut up. Elaine said, your story is even more crazy. I have 3-month-old and can't even imagine how I'd feel. Yeah, I mean, congratulations on your little one. It's the best feeling ever in the world, being a dad, bar nothing. But yeah, it was a tough time, but me and the missus are super resilient. So For props, 5 as an alpha are okay too, but I think funding companies are good to start. After that, they push you out, so nothing better than a personal and Darwin. Yeah, I don't like alpha at all, and I'll explain why. So alpha, I took a look at, and they ask for the source code of your strategies, and that is just an absolute big no-go for me. I would never dream. Why is there a big line in my? Oh, there we go. I would never, ever dream of giving anybody access to the source code of XAQP. Not a chance. Not when XAQP has a capacity of around 13 million, right? Which means if I can scale to 13 million over the next few years, maybe it goes up, maybe it goes down, who knows? I can make so much money. Why am I going to give you my source code to my strategies? Just mind-boggling that they would even ask for that. But, you know, I understand it's their business, it's their rules, so they can do what they want. But there's no chance I would ever trade with alpha. No chance. Only because of that. Like, I'm agnostic otherwise, but the fact that they ask for the source code is just an absolute no-go. If you also aim for Supreme, like I do, make sure to have a 400k with Prime on it. Otherwise, if you have it on 100k, for example, it's going to make everything so much worse and slow. Yeah, so I have 400k. They're still in challenge at the minute. Still in the challenge phase, but I have 400k. The goal is to get them live. Let it trade. Take 4% payouts. Calm down. Sit down. And then yeah, eventually get Prime, and then if it goes to Supreme, if it goes to Quant Lane, who knows? I'm probably the worst trader in the world because I just don't care. So it is what it is. If something happens, you know, 2 years down the line, well, then it's great. If it doesn't happen, well, guess what? That's also great. And I think as a trader, that's the best way to be. Just being agnostic about what happens in the future, letting things happen naturally, let things come to you, and don't chase returns, don't chase people, and don't chase you know, new strategies. Is the message there. But anyway, guys, I have to leave. Again, I've got something that I need to attend to at 1:15. So it's been an absolute pleasure chatting to you all today. I mean, the chat's been super busy today, which is great. I say it every time, but I always love it when you guys are commenting, because it means I don't have to sit here and talk to a camera for, you know, for the whole hour. So I appreciate everybody who's got stuck in and asked me questions today. If you would like me to do another session specifically on strategy building, because there's quite a few questions based on that, I'm more than happy to do that, and we can kind of deep dive into my process again of doing that sort of thing, if it's something that you guys would like to see. So anyway, I'm going to wish you all a fantastic rest of your morning, afternoon, or evening, wherever you are in the world, wherever you're watching it from. If it is evening for you, go get some sleep, go chill out, put your feet up, hang with the missus, or hang with your fella. Make sure you get in some rest, because the markets will always be here tomorrow, and it's FOMC, Fed interest rates, in like an hour or 2 hours or something like that. I can't remember with the new time zones. It was a pleasure, Alan. Yeah, always, dude. Have a nice evening. So guys, have a fantastic rest of your day, and I will catch you tomorrow at 4 p.m. UK time. We have the guys from Edge One attending that session with us tomorrow as well, where we will finally announce the winners of the giveaway that we did like 2 or 3 weeks ago. So peace out, guys. Have a fantastic rest of your day. Thank you all for joining.